Imagine trying to install a brand new, futuristic engine on a commercial airplane.
Right, which sounds totally impossible.
Oh, and you have to do it while the plane is actively flying.
Yeah, like 10,000 feet.
Exactly, through heavy turbulence.
That sounds like an absolute nightmare.
Well, that is exactly what Surf Air Mobility is attempting right now. Welcome to Talk Tickers, where we break down the earnings calls that are moving the markets.
I'm really excited for this one. We are doing a deep dive today.
Yes, we are. The mission for today's deep dive is to unpack one of the most ambitious corporate metamorphoses in recent memory. We are looking at a struggling, highly capital-intensive regional airline.
Right, a very tough business.
And they are trying to transform themselves into a high-margin, AI-enabled aviation software platform. Oh, and also a pioneer of commercial electric flight.
It is, it's a massive pivot. And to really understand it, we have to start with the raw results from their Q4 and full year 2025 earnings call.
Right. And as always on Talk Tickers, we'll start with a summary of the results before we go in depth. For the fourth quarter of 2025, revenue came in at $26.4 million.
Which is down, right?
Yeah, it's down 6% year over year. But it landed right within management's guidance. And full year 2025 revenue hit $106.6 million.
Okay, so the top line shrank a bit, but operationally they had some wins.
They did. They hit an all-time high of 98% for their controllable completion factor.
Oh, wow. That's up from what, 89%?
Yeah, exactly. And on-time departures climbed up to 72%. They also reduced net debt by 47%.
That's huge, bringing it down to $74 million, I believe.
You got it. And the big headline they really wanted everyone to see was that the core airline operations actually achieved positive adjusted EBITDA for the full year.
Which is a major milestone for them. But looking ahead, they are guiding for a massive jump, like $128 million to $138 million in revenue for 2026.
Which signals a huge transition from restructuring into aggressive growth. Okay, let's unpack this. Put yourself in the shoes of an investor looking at a company with this massive industry-defining vision. Right?
Yeah, a huge vision, but operating with a very, very tight balance sheet.
Exactly. To understand the software and electric future they're selling to you, we have to dissect that 2025 baseline we just summarized.
We really do, because the fourth quarter showed a company that was basically fighting to stabilize its core legacy business. Right. You mentioned that Q4 revenue was $26.4 million, down 6% year over year.
Right.
Normally, when you see top-line revenue shrinking in an earnings report, your immediate instinct is just to panic.
Yeah, usually means you're losing market share to competitors.
Exactly. But in this case, the shrinking was entirely intentional.
Wait, intentional?
Yeah. The reality of a legacy turnaround is that you have to stop the bleeding first. Management intentionally exited a series of highly unprofitable scheduled routes.
Oh, I see. So they just stopped flying planes on routes that were guaranteed to burn cash.
Precisely. So yes, the overall top-line revenue shrank, but the underlying unit economics of the flights they actually kept improved.
They essentially stopped paying for the privilege of flying empty seats.
Right. And that leads directly to the debt reduction, which is a critical mechanism here. They cut their net debt almost in half, down to that $74 million.
And a massive chunk of that was achieved by converting $48 million in convertible notes, right?
It was. And for anyone, not totally in the weeds on corporate debt restructuring, let's explain how that works in practice.
Yeah, basically, convertible notes are a type of short-term debt that can be converted into equity.
Meaning shares in the company.
Exactly, at a later date. So what Surf Air did was effectively swap debt for equity. They went to their lenders and convinced them to take company stock instead of demanding cold, hard cash repayment.
Which is a double-edged sword. On one hand, this instantly cleans up the balance sheet and removes that crushing burden of interest payments. It gives them breathing room.
But on the other hand, it completely dilutes the existing shareholders because you are creating new shares out of thin air to hand over to those debt holders.
It's a survival tactic, plain and simple.
It is. But I have to push back hard on this next point because there's a glaring tension in these financials. Management is out there celebrating the fact that the core airline operations achieved positive adjusted EBITDA for the full year.
Yeah, they were very loud about that.
But if you look at the actual bottom line, the company still posted a GAAP earnings per share miss of around negative 41 cents for Q4.
Right.
And if you zoom out to the whole year, the full year net loss actually widened to $110.5 million. So why is there such a massive gap between the adjusted EBITDA they are cheering for and the GAAP reality that looks terrible? Are they just shrinking to survive?
What's fascinating here is how this perfectly highlights the overarching tension of the business model. That is the million-dollar question for anyone evaluating asset-heavy businesses like airlines.
Because of how EBITDA is calculated.
Right. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's essentially a measure of whether the day-to-day operations actually generate cash.
Like putting a pilot in a plane and flying a passenger from point A to point B?
Exactly. And by that metric, they succeeded. The flights themselves are now profitable.
But GAAP, generally accepted accounting principles? Well, GAAP forces you to tell the whole story.
It forces you to account for absolutely everything. And the biggest culprit here is depreciation. Airplanes are incredibly expensive physical assets that lose value every single day they sit on a tarmac.
Yeah, and GAAP forces the company to deduct that lost value from their earnings.
Add in the heavy stock-based compensation they use to retain talent, and suddenly that operational profit turns into a $110 million net loss on paper.
Wow.
They are showing real operating improvement. They cleaned up the debt. But at the end of the day, flying physical planes is a fundamentally flawed, low-margin business.
Which explains exactly why they are trying to stop being just an airline. And that brings us right to CEO Deanna White's bold statement on the call.
What did she say?
She stated, quote, "Today we are no longer resetting, we are pivoting to growth."
The pivot.
Yeah, they are guiding for 20% to 30% year-over-year revenue growth in 2026. But they aren't going to achieve that by buying more physical planes. They are attempting to pivot into an aviation platform.
And the engine of that pivot is a software suite called SurfOS. This is where the narrative completely shifts from surviving to scaling.
Let's get into the software side then.
Yeah.
Surf signed a 5-year exclusive partnership with Palantir to build out this AI-enabled software suite specifically for the Part 135 market.
And for those unfamiliar, Part 135 is the specific FAA regulation that covers commuter and on-demand operations, basically the charter plane market.
Right. And to understand why SurfOS is such a big deal, you have to realize just how archaic the charter industry currently is. It's notoriously fragmented.
Oh, it's incredibly fragmented. You have hundreds of mom-and-pop operators, independent brokers, and just private owners.
Yeah, and right now, a staggering number of these businesses are coordinating multi-million-dollar private flights using disconnected Excel spreadsheets or physical whiteboards.
And endless games of phone tag. It is an operational nightmare. A broker gets a call from a client wanting a flight. That broker then has to manually call 5 different operators to see who has a plane available.
Who has a rested crew, what the pricing is for the day. It's wildly inefficient.
So SurfOS is stepping in to fix that.
I've heard it compared to a consumer marketplace, but that doesn't feel quite right to me. It's not just like a Zillow or MLS for charter planes. It's much deeper.
How do you mean?
Well, it sounds like they're trying to build the underlying digital infrastructure itself. It's like bringing Salesforce or AWS to an industry that's still running on Rolodexes and fax machines.
Yeah, that is a much more accurate analogy. They're building the operating system for the entire ecosystem. For instance, they have BrokerOS, which gives third-party brokers a tech-enabled sales and pricing tool.
And they've already deployed that internally, right? It's currently generating revenue.
It is. Then you have OperatorOS, which handles the incredibly complex logistics of crew scheduling, maintenance tracking, and flight quoting.
And that one is currently in a closed beta with 17 different operators.
Correct. And finally, you have OwnerOS for the people who actually own the physical assets. The margin profile difference here is what makes this pivot so critical.
Because, like we just discussed, flying physical planes has terrible margins. You are constantly battling jet fuel prices, weather delays, expensive maintenance.
And pilot shortages. Every extra dollar of revenue costs you 80 cents to generate in the airline business. But software scales beautifully.
Right, because once you build the core architecture of SurfOS, the cost to add the 18th or 50th or 100th operator to the platform is virtually zero.
Exactly. You transition from an asset-heavy airline to an asset-light, high-margin SaaS company, software as a service.
That 20% to 30% revenue growth sounds amazing on paper. But as an investor, You have to look really closely at the timeline here.
You absolutely do.
Yeah.
Because if you look at their Q1 2026 guidance, management is expecting an adjusted EBITDA loss of $13.5 million to $15.5 million right out of the gate.
Oh, okay.
And they explicitly started that this first quarter guidance includes absolutely zero revenue contribution from SurfOS.
Wait, zero. So the commercialization is happening, but the actual monetization hasn't shown up yet.
Exactly. This means that the aggressive full-year growth target is heavily weighted to the back half of the year.
You really have to trust that their sales pipeline is rock solid, and that those 17 operators currently in the closed beta will actually convert into paying software clients by the third and fourth quarters.
It requires a lot of faith in their execution.
Okay, so they are placing a massive bet on Palantir-powered software to capture the charter market, but software is only half of this transformation.
Right, because while they want to be asset light, they do still fly planes.
And the physical assets they fly are undergoing a massive strategic pivot of their own regarding electrification. Up until recently, Surf Air had a highly publicized internal project to electrify their fleet of Cessna Caravans.
Yeah, they were prepared to spend upwards of $50 to $100 million on internal research and development to build their own proprietary electric powertrains.
But on this earnings call, they announced they are completely canceling that internal R&D spend. Here's where it gets really interesting, though, because I have to play devil's advocate for a second.
Go for it.
They spent years working on that electrified caravan project. They generated endless press releases about it. They burned millions on engineering. To suddenly pull the plug on the call and say, we aren't going to invest that $100 million anymore, doesn't that look like admitting total defeat?
I can see why it looks that way.
Aren't they just throwing away all that past investment, taking a massive sunk cost hit, and handing the keys to a third-party manufacturer? How is that not a giant red flag for you?
If we connect this to the bigger picture, it is actually a masterclass in capital allocation.
Yeah.
And it shows management is willing to kill their darlings when the facts change.
Okay, explain that.
You have to look at the competitive landscape of aerospace engineering. Over the last decade, companies like Beta Technologies, Joby, and Archer have spent billions of dollars in venture capital developing clean sheet electric aircraft from the ground up.
Billions. Yeah.
So why on earth should Surf Air, a regional operator with a $74 million net debt load, try to fund a $100 million internal R&D project to compete with Silicon Valley venture capital?
Ah, so they recognized they were outgunned. They recognized they are an operator, not a manufacturer.
Exactly. By canceling the internal project, they instantly stop a massive risky cash burn. They announced a firm order for 25 fully electric aircraft from Beta Technologies instead, with options to purchase 75 more.
And these Beta aircraft span different configurations, right? Seat variants for passengers, cargo variants, and even vertical takeoff and landing models.
Yes. They let Beta foot the bill for aircraft development, and, more importantly, they let Beta take on the grueling, multi-year FAA certification process.
Which Beta is actually making tangible progress on. It was noted that Beta was just selected for 7 out of 8 slots in the FAA's Elevated Implementation Plan, or EIP.
Which is a huge deal.
Yeah, it's a specific regulatory program designed to expedite certification for new aviation technologies. Management noted that this EIP inclusion could potentially speed up getting these Beta planes certified for commercial passenger use by up to a full year.
That is the crucial point. Surf Air gets to be the launch operator, reaping the benefits of electric flight without taking on the billions in R&D and regulatory risk.
And the unit economics of these Beta planes are just staggering. Management anticipates a 30% improvement in operating costs compared to traditional turbine aircraft.
Let's drill into the mechanics of that 30% cost reduction, because it isn't just about saving money on jet fuel. A massive chunk of that savings comes from a staggering reduction in maintenance downtime.
Yeah, the numbers here blew my mind. Management stated that a traditional Cessna Caravan has to be grounded for routine maintenance inspections 24 days out of the calendar year.
And the new Beta electric aircraft, 2 days. 2 days a year.
Wow. Wait, really? Just 2 days?
Yeah, exactly 2 days. The mechanical reason for that is fascinating. Think about a traditional turbine jet engine. It is a highly volatile piece of machinery with thousands of complex, fast-moving parts operating at extreme temperatures.
You have gearboxes, fuel pumps, ignition systems, exhaust manifolds.
Exactly. All of those physical parts experience intense friction and thermal stress, which means they require constant mandated teardowns and visual inspections by highly specialized mechanics.
Because if one tiny turbine blade has a microfracture, the plane falls out of the sky.
Right. Now compare that to an electric motor. An electric aviation motor basically consists of a central spinning rotor suspended in a magnetic field. There is no combustion, there are no gearboxes.
So there are a fraction of the moving parts, and therefore virtually nothing to wear out or break down from thermal stress.
The system relies on software and solid-state battery management. So instead of taking the engine apart for 3 weeks to check for metal fatigue, a mechanic can run diagnostic software and do a visual check in 48 hours.
That means that the plane is back in the sky, generating revenue for an entire extra month compared to a legacy aircraft. That completely changes the math of running an airline.
It really does. But Surf Air isn't just buying these planes to fly them. They committed $22.4 million to infrastructure upgrades in Hawaii, specifically partnering with Mokulele Airlines.
And the absolute kicker of this whole beta partnership is a single contractual clause. Surf Air secured an agreement to be the exclusive factory-authorized maintenance, repair, and overhaul center in Hawaii.
The MRO Center. That right there is the true strategic pivot of the entire company. They aren't just an airline buying new planes to fly tourists between islands.
They are locking up a maintenance monopoly in one of the most critical launch markets for electric aviation in the world.
When any other operator eventually buys beta aircraft to fly in the Hawaiian market, they won't be able to fix them themselves. They will have to go to Surf Air's hangars, pay Surf Air's mechanics, and buy parts through Surf Air to get them serviced.
So what does this all mean? If you step back, the strategic story sounds completely bulletproof on paper. You have AI software scaling a highly fragmented, low-tech market.
You have electric planes promising 30% lower operating costs and a month of extra flying time.
And you have an exclusive maintenance monopoly locked in. But then you look at Wall Street's reaction to this earnings call, and it is a totally different, much harsher reality.
The market reality is incredibly unforgiving right now. Immediately after the after-hours call wrapped up, the stock actually took a slight dip, dropping about 1.1% to around $1.86.
And the next morning, it seemed like retail investors were leaning into the 2026 growth narrative, and the stock bounced up to $2.15, but it quickly pulled back again.
And if you zoom out to the macro level, the context is even tougher. Over the last year, the stock is down roughly 46% to 48%.
It is severely lagging behind the broader market, and it's even lagging behind the airline sector ETF, ticker JGTs, which has managed to stay positive over the year despite intense industry pressure.
Yeah, pressure from structurally high oil prices and geopolitical tensions disrupting global travel. And the reason for that pullback, the reason the stock is struggling to catch a bid despite this futuristic vision, is sitting right there in the 2026 guidance we discussed earlier.
Yes, they project $128 to $138 million in revenue, but they're also projecting a hefty adjusted EBITDA loss of $40 million to $50 million for the year.
That is real cash burn. That $50 million loss is the exact cost required to fund this platform transition, to fund the Palantir engineers building SurfOS, and to fund that $22 million Hawaii infrastructure commitment.
It creates a massive divergence between management's focus and the market's focus.
Management is looking at 2027 and beyond. They are looking at structural transformation, optionality, future high-margin software recurring revenue, and the economic windfall of electric aviation.
While Wall Street, on the other hand, is looking at the next 90 days. They see the cash burn. They see the widened gap losses from 2025. And they see a very soft setup for Q1 with absolutely no software revenue proving the model yet.
What stands out to you here, if you are looking at your portfolio right now, you have to ask yourself the hard question. Are you willing to stomach a $50 million cash burn this year just to hope they execute on this vision next year?
Because that is exactly the standoff happening between this management team and the market. It is the ultimate test of investor patience.
It really is.
To quickly recap the journey of this deep dive, we're looking at Surf Air Mobility, a company that has successfully shrunk its legacy regional airline, amputated the unprofitable routes, and achieved operational EBITDA profitability to stop the bleeding.
But instead of just resting there and trying to grind out a living in a tough sector, they are actively placing massive company-defining bets.
They are rolling out Palantir-powered software to capture the charter market, and they are partnering with Beta to bring electric aircraft to the skies, fundamentally altering their unit economics and their entire role in the aviation ecosystem.
And this brings us to our final segment. As always on Talk Tickers, we end with our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on the call.
And this is strictly a thought exercise, to be completely clear. Absolutely not financial advice. But think like a special situations hedge fund analyst pitching a wild hypothesis to an investment committee. Let's hear it.
Okay, so what if the ultimate value of Surf Air isn't in flying passengers at all? We know flying regional routes is a notoriously difficult, heavily regulated, low-margin business subject to the whims of weather and consumer demand.
Very true.
But look closely at the Beta Technologies deal. If Beta's electric planes actually work, and if they come to dominate the short-haul island-hopping market because of those massive cost advantages, someone has to service them. Surf Air just locked up the exclusive rights to maintain and service those specific aircraft in key launch markets like Hawaii.
Oh, man. They effectively become a toll booth for the future of flight.
Exactly. The true long-term play here might be entirely ignoring their legacy airline revenue. What if the market is punishing them right now for being an unprofitable airline, while entirely missing that the stock is secretly a backdoor monopoly play on electric aviation infrastructure and maintenance?
That makes total sense.
Wow.
If electric planes become the standard, the company holding the exclusive service contracts holds all the leverage.
You essentially short the idea of them being an airline and go long on them being the mechanics of the future.
That is a fascinating way to look at it. You come into the call looking at a struggling regional airline shrinking to survive, and you walk away looking at a potential infrastructure toll booth for the next era of aviation.
It's a wild shift in perspective.
Thank you for joining us on this deep dive of Talk Tickers. Keep questioning the consensus, and we encourage you to keep exploring the data on your own. We will see you next time. We leave you with this final thought. If you had to install a new engine mid-flight, would you rather be the pilot risking everything to fly the plane, or the one who owns the exclusive patent on the wrench?